Lucy, we will attempt to get through this with as few gambling puns as possible, but Macau, which already has 7 times the amount of gambling revenue as Las Vegas, appears to be slowing down as a casino destination. Why is that, and how bad is the slowdown?
Well, the stocks have been hit quite hard this week as the July gambling revenues came out at a drop of 3% year on year, and it's the second month in a row that they've had a fall of 3% year on year. Analysts are trying to pin the slowdown on the World Cup, saying that people just stayed at home. But actually, if you look at the overall tourist numbers, they were up 5% year on year for June. So that sort of doesn't seem like a very good argument. So actually what hit the top line altogether was the fact that mass market had a much bigger slowdown than analysts were hoping, and the growth has now slowed from 17% to 14%, while VIP also dropped, but less than it had previously. But nonetheless, I mean, all in all, the figures are going in the wrong direction.
I mean, this is seems to be a conundrum to me, because even if growth is slowing down, those numbers sound to me like quite fast growth still. So the likes of Wynn Macau and other casino stocks still seem pretty good investments, no?
Well, I think you need to separate sort of the short-term impacts from the long-term impacts, and there are sort of good and bad on both sides. In the short term, we're hitting capacity constraints. Some of the casino hotel rooms are seeing 95% occupancy rates at the weekend, and there's a bit of a bottleneck in terms of capacity. The new capacity doesn't start to come on until next year. So that's potentially one of the reasons that you're getting slower growth. When you look at the long term, though, you've got a bit of a shift between the VIP market and the mass market. Now, a shift towards the mass market is a good thing because the margins are much higher in the mass market. But then again, it's also potentially a bad thing, because while your kickbacks to the VIPs obviously reduce as your VIP relative take reduces, the marketing spend potentially to try and attract those mass market customers as the growth slows down potentially also increases. And if you look at the overall numbers of tourists last year to Macau, it was 29 million. So you may get capacity increases from the casinos, but then potentially you're running into risks with the Macau government. You just don't know what their policy will be in terms of numbers of visitors, and we've already seen problems in Hong Kong with that.
And yet, I mean, briefly, 29 million people, you know, it's a lot, and it's a lot of cash, really. So aren't these stocks really, you know, even though if growth is slowing down, they're still cash machines? That's my point.
They are cash machines, but then you have to look at them on a yield basis, and a 5% yield seems reasonable. It seems a pretty decent yield. But for the higher yielding companies, they're already paying out 72 to 100% payout ratios. So if you have any kind of wobble in the outlook, if the corruption issue in China continues, you know, any kind of top line or margin impact is potentially damaging to that yield. So I think at the current levels, even from a yield perspective, there's still a reasonable amount of risk that the stocks could come off further.
Okay, sounds like the house doesn't always win. Thank you, Lucy.